Hello everyone and welcome to today's session, which is hosted by the Hellenic Financial Stability Fund and the Prime Collateralised Securities Association. My name is Alex Karagianidis and I will be your moderator for this session on behalf of the HFSF. Before we start, just a little of housekeeping. If you have any questions that you want to raise to our presenters or any technical issues, please address them via the chat box, and after the end of the presentation, we will address all questions in a Q&A session. We will try to cover as much ground as possible. Any unanswered questions, we will try to tackle offline. And now, without further ado, I would like to turn it over to the Chief Executive Officer of the HFSF to address with opening remarks, Mr. Ilias Xirouhakis.
Ladies and gentlemen, good afternoon. I am, as Alexander said, the Chief Executive Officer of the Hellenic Financial Stability Fund. And I would like to warmly welcome you and, of course, thank you for the participation on this joint initiative with Prime Collateralised Securities PCS and the Fund. As you may already know, HFSF has recently joined PCS as a permanent observer, and we are happy to host this webinar in order to introduce this collaboration and share valuable knowledge and insights. PCS is an independent non-for-profit initiative, and it is set up to reinforce the asset-backed securities market in Europe as a key on generating robust and sustainable economic growth for the region. HFSF, as the shareholder of all four systemic banks and key stakeholder in the Greek banking sector, acknowledges the importance of securitization activity while keeping in line with best practices and regulatory guidelines. HFSF is the first Greek institution to join PCS Association, and we're certainly proud of that. At HFSF, we wish and aim to have an active dialogue with all Greek systemic banks individually, Bank of Greece, the Hellenic Bank Association, the government, as well as with think tanks in order to contribute to a sustainable financial environment and promote international best practices. By joining PCS, HFSF will enhance its contribution to such a dialogue and promote a constructive discussion in further leveraging the use of securitization. As a permanent observer, HFSF now has access to a broader network of experts with significant experience in securitization markets who are also in active ongoing dialogue with the regulators, and this is very important in our view. During today's session, the team of PCS specialists will cover practical considerations around the simple, transparent, and standardized securitization regime. This, in our opinion, is an important agenda, but also a vast one, and since time available to us is unfortunately limited, I will now pass the floor on to Mr. Michalis Haralabidis, the HFSF's Chief Risk Officer and liaison with PCS, for a few additional comments before we actually dive into the interesting technical details of securitization. I sincerely hope that this session will be valuable to you, and let me conclude by saying that we are strongly believe that initiatives of this kind accelerate the exchange of ideas and scaling up of good practices. Thank you very much. Michalis, the floor is yours.
Thank you, Ilias. Good afternoon from me as well, and welcome to our joint initiative with PCS, which is the webinar on securitization. I would like to say that this is the first attempt to discuss this key topic in the form of knowledge sharing session, and we hope that we will hold a similar session in the near future with your support, of course. Before moving on, I would like to elaborate on our thoughts around the developments in the securitization market. As you know, the Greek securitization market has been dominated by NPL transactions, Greek banks made significant progress with their deleveraging, NPE disposals in 2022, this reduction exceeded 30 billion. This was primarily through NPE securitization following the successful implementation in 2019 of the Hellenic Asset Protection Scheme, known also as Hercules. As Ilias mentioned today, today's webinar focused on STS, thus not directly related to NPL transactions. However, and since the buyers in these deals are long-term institutional investors, an evolving framework for NPL similar STS could also be a benefit for this type of transactions too, and can potentially expand the investor base for Greek NPLs deals. So we will further investigate this option in the future with PCS. Our view is that securitization is an important tool to enhance lending to the real economy and should be used by banks in its full capacity. Therefore, it's not only NPL securitizations or true sale transactions that should be considered, but also synthetic securitizations, which offer lucrative features in contrast to true sales deals. And this can be used, especially in the case of SME loans, which are very, very important for the Greek market. As you know, the EU regulatory framework for securitizations that is enforced standards for all securitizations and defines criteria for simple, transparent, and standardized STS securitizations. Thus, it provides a strong affirmation of the European regulators' confidence in these tools and for the growth and development of the European economy within the Capital Markets Union. In addition, we are planning to follow closely other areas of securitizations that have attracted recently the market's attentions, like green or sustainable securitizations, which can play an important role in facilitating the green transition in the financial markets. Green securitization issuance is currently subdued because of the uncertainty regarding the requirements to be satisfied. But as European ESG bonds and loan market increases substantially, we had 184 billion of issuance in Q1 2021, with a remarkable increase of more than 200% since 1 year before. So we expect green securitization to be the next hot topic in our agenda. We will also follow closely and expect EBA to publish its report on sustainable securitization at the end of the year. As you can see, there is a lot of interesting and developing topics around securitization that we're going to cover. Now I would like to extend a special welcome to our partners, PCS, who made this event possible, and give the floor to Mr. Ian Bell, the Chief Executive Officer of the Prime Collateralised Securities. Thank you.
Thank you very much. Thank you very much for our host, the Hellenic Financial Stability Fund, and also welcome, of course, as you've joined PCS as permanent observers. So I think I will start just by introducing ourselves very briefly. I don't want this to be about us, but just so you know who's speaking during this panel. So Prime Collateralised Securities was set up in 2012. As it was said, we are a not-for-profit organization. So you have to put yourself back in the time. 2007, 2008, of course, subprime securitization has a disastrous impact on the world economy. This is made worse via certain really dangerous products like CDO, CDO cubes, CDO squares, re-securitizations. And the narrative that emerges from the crisis is that basically securitization is some hideous, illegitimate form of financing. It is a tool for sharp-suited American investment bankers to make lots of money at the expense of hardworking citizens across the world. It is truly a tool of evil. Now, that doesn't actually reflect the reality of what happened in Europe, and for that matter, what happened in Asia, where securitization held up extremely well. The problem wasn't in securitization as a technology. The problem is the way that technology had been used. And people at the time made the point, you can have a hammer in your hand, you can use it to build a house, you can also use it to hit your neighbor. It's the same hammer, the problem is not with the hammer. But nevertheless, after the crisis of 2008, within the European Union, there was a tsunami of regulations that were designed to restructure in a very profound way the financial world. And out of those, you will know, came EMIR and MiFID and a whole host, and the regulation of credit rating agencies and the CRA regulations. I mean, I was in Brussels at the time, and it was quite extraordinary. I mean, the dozens and dozens of deep regulatory changes that were made to the financial landscape was amazing. And part of those restructurings, including the Basel agreements, the Basel III that came out, part of those restructurings really were designed to destroy securitization. I don't know why the slides are moving, but you might want to move just to the list of members and observers, Harry. Okay, let's leave it there. So a lot of the general feeling was securitization was a terrible product. It had to be killed. It had to be killed. And at the time, the European Central Bank, together with market participants, thought that there was a lot of good that securitization could do to the banking system as a whole. And I'm not going to go through all of those points now, but that to destroy securitization through regulatory intervention was really to throw away the baby with the bathwater, to use the English expression. It was to destroy a tool that could be used very well and very safely, and had, by the way, been used very well and very safely in Europe because of bad apples in the barrel, primarily bad apples that came from the United States. And when they were thinking together, what can we do? The basic thought is we collectively, both on the public side and on the private side, policymakers as well as financial market participants, we had to analyze the crisis, we had to understand the crisis in securitization, and we had to identify the things that had gone wrong. And as I said, using the hammer analogy, what had gone wrong was not the hammer, what had gone wrong was the way the hammer had been used. And to do that, it was decided to set up a body, which became PCS, that would be a not-for-profit, independent body, so we're not a trade association, we don't represent our members, whose job was to identify, understand what had gone wrong, and was to then promote what had gone right as a way of doing securitization. And this was done in 2012, we were set up, and you can see our members, many of our members on the slide were there at the beginning. But you can also see the list of permanent observers, to which of course now the Hellenic Financial Stability Fund has been added, and that's a wonderful new addition. But very early on, if you look at the permanent observers, who are people who are involved, but for political, constitutional reasons cannot be members of a private sector organization, you will see that the European Central Bank is there, the European Banking Authority is there, the European Securities Market Authority is there, ESMA. So you will see that the public sector also had, from the very early on, a big involvement in PCS in setting us up. And having been set up, we did what we were set up to do, which is that we defined high quality securitization by looking at the crisis of 2008 and understanding what had gone wrong and what had gone right. We published a paper in 2013. Interestingly enough, the analysis that we did of what had gone wrong and right in 2013 was picked up by the EBA, and they very kindly, in their official report to the Commission, which was the seed of the new regulations on securitization. In that report, the EBA acknowledged explicitly the debt they had in terms of the analysis of what had gone wrong and what had gone right in securitization during the crisis. They acknowledged their debt to the work that PCS had done. We created a label, a private sector label, but really the private sector label was a tool to show both the regulatory community and the policy-making community what could be achieved with securitization on a safe and sound basis. And that work, of course, ended successfully, at least semi-successfully, in 2017, when the European Union passed the securitization regulation, the STS regulation, that created this category, simple, transparent, and standardized, STS, securitization, which was going to benefit from some regulatory advantages, and therefore would allow securitization, safe securitization, to go on. So that's what we do. That's what we did. In 2017, when the new regulation was passed, it came into effect in January 2019. In that regulation, and very much at our suggestion, is also the idea of an independent body, regulated independent body, private sector body, that would verify STS. Because one of the concerns of the regulators was that bad actors, like in 2008, 2007, would play around and would cheat, if you want. And so the concept was introduced that independent regulated third parties could verify the work of the bankers when they notified STS securitization. And we, PCS, became such an institution. So now we are regulated. Now we verify STS securitizations. And that is how we continue. We are still a not-for-profit organization, so nobody is making any money from our work. We are legally a not-for-profit organization, so our parent company is actually a legal not-for-profit Belgian association that is legally prohibited from giving money to anyone, be they members or shareholders. And we continue to be an independent body, and now we are a regulated body, both in France and the United Kingdom. We're regulated by the French Autorité des marchés financiers and by the British Financial Conduct Authority. So that's who we are, and I'm not going to go beyond that. Obviously, you can see our team is there, and you can click on the various LinkedIn icons and find out who we are as human beings. But this is basically what PCS is about. So now, Harry, if we could move on to the main presentation, which is going to be a bit about what securitization is generally, and talk about the regulation of securitization, and then talk more specifically about synthetic securitization, which in a way is the bulk of our talk today.
Yes, Ian, I think, you've been involved in securitization for more than 3 decades. To the 80s, I would say, right? And if you were to describe in a few words, what is securitization all about? What would you say? If somebody says, Ian, just very simple, what is it all about?
Yeah. Okay, so yes, sadly for me, I've been in securitization for 33 years now. My first deal was back in '88. There are legal definitions of securitization. They're different in Europe and in the United States and in Australia. But ultimately, forgetting the legal definition, there are two fundamental things that you need for your financial product, your financing methodology, to be a securitization. The first one is that it's an asset-only risk, and the second one is that it is tranched. What does that mean? Securitization is a way of financing assets that are generated on the balance sheet of banks and lending institutions, leasing institutions. So there is an institution, usually a bank, but sometimes, as I said, a leasing company or whatever, that generates assets. And those assets have a quality, and investors will want to invest in the assets. So the entity that has originated these loans, made them in the first place, is called the originator, and it finds investors who are prepared to invest in the assets. But what is important to understand about securitization is this asset-only risk. That is, securitization is not a form of secured finance, right? In a secured finance, you will lend to an entity, let's say a bank, and they will provide security for that loan so that if they go insolvent, you can say, well, at least we've got their headquarters, we'll take their headquarters. That's not securitization. In securitization, the investors take only the risk of the assets. So the bank will have a pool of 5,000 mortgages, and it will securitize those mortgages. What happens to the bank, whether the bank is solvent or insolvent, doesn't matter. The investors will be paid back if the mortgages pay, and the investors will take a loss if those mortgages do not pay. That's it. And there is no guarantee from the bank, there is no obligation from the bank, there is nothing from the bank. You're basically investing in the mortgages and nothing else. And that's the first basic concept of securitization. It's asset-only risk. You invest in the pool of mortgages, you invest in the pool of car loans, you invest in the pool of credit card debt, you invest in the pool of SME loans. You do not invest in the bank or the lender that has originated those assets. That's the first thing.
Ian, I see that as an investor, when do I get paid? What is the benefit for the originator to do such a transaction? I mean, how does that work?
Okay, so there may be many benefits for the originator to do that that transaction. First of all, you can finance the assets. So securitization can be a financing tool because you receive the value of the assets. So if you have a pool of €1 billion, you will basically be able to finance that €1 billion. So you refinance the assets effectively. Secondly, it allows you to do match funding because we said the investors only take the risk of the assets. What that means is not only that the investors only get paid if the assets pay, but there is a concept in securitization known as pass-through. The investors not only get paid if the assets pay, they get paid when the assets pay. So, for example, and it's particularly important for mortgages, people have a 20-year mortgage, but of course they move house. So they may pay that mortgage after 1 year, they may pay that mortgage after 5 years, 7 years, 9 years. Because securitization is the pass-through, you pass through the money you receive on the assets to the investors. That means the investors only get paid when the assets pay. But what that means from the originator point of view is you have match funding. Right? Banks, what makes banks intrinsically fragile is that banks finance long-term assets, mortgages, 10-year loans to corporations, with short-term liabilities, right? Deposits, which are on demand, or sometimes, commercial paper, or repos, which are 3 months. So one of the things that makes banks fragile is, of course, the liquidity. If you've got a 10-year mortgage you're financing with a deposit that can be taken out of the bank any day, you've got a problem if that deposit is taken out. You have to refinance that deposit. But because in a securitization, that mortgage, that 20-year mortgage is passed on, the risk, both in timing and credit, is passed on to the investor, that means that if you've received that money for passing on that risk, that money is not returnable. Right? The investor has accepted that he now commercially owns the asset for all intents and purposes. And that means that if the mortgage just pays in 20 years or pays in 3 years, you don't care anymore. You have effectively match funding. Not even technically match funding because you've actually got the money, you keep it. But now, for that whole pool of mortgages that have been securitized, you no longer have a liquidity risk. Before, you were funding that with deposits and short-term deposits and other short-term instruments. You had a 20-year mortgage, you were at risk. Now the mortgage has been sold out, you've got your full money back, it's match funding. And that means banks or a lot safer with securitizations.
And I have to say, as an investor, I was on the receiving end of that when, following the crisis, I had a ton of Greek, Spanish, Portuguese, Italian securitizations, where most banks decided to extend those loans. And as a result, my 5-year, 7-year ABSs, weighted average life bonds that I had invested, end up being 15, 20-year bonds, and there was very little I can do. But when I was calling the banks and asking them, are you going to call those deals? Are you going to do something about it? They say, listen, the asset spread on the assets around 80 basis points. I got funding from you at 15 basis points. It's 65 basis points plus the spread. Performance of the assets is fine. If I want to refi, I'm going to have to do it at 100 basis points. No, thank you very much. I keep on taking your money at 15 and just pray for these people to pay faster if they do. So in the end, the bank was still profitable despite the fact that asset spread, everything liability side has massively changed. They had locked in a certain spread between the asset and the one of the liabilities. And for them, they were very happy that securitizations were still going on. So I have to say that's a very, the one thing you could do is you can lock in the spread at the time you originate the loan, and you don't have to worry what happens when you refi that.
Absolutely, and that also is another one of the advantages of securitization as part of a bank's spread of financing tools, which is that we said the securitization, the investor relies entirely on the assets, but also is at no risk from the bank. That's what we mean by asset-only risk. So you can't be at risk from the bank. What that means, of course, is that when banks run into difficulty, they are able still usually to access the securitization market, because a bank can be in difficulty for a whole variety of reasons. But its assets, its car loans, its SME loans, its mortgage loans are not necessarily in trouble. And we are aware, and this is not secret. The Santander has said this openly, and I know that you, Harry, have a long history with Santander. When the crisis hit, Santander, where everybody was wondering about, Spain and banks which have a lot of exposure to emerging markets, a lot of exposure to the Spanish economy, Santander was able to issue securitization bonds, even though it couldn't issue bonds in its own name, because people were worried about what was happening to banks. And there was a period, however, where Santander was able to continue funding itself, because to the extent that securitization removes the bank risk, it means that a bank in trouble can say to the market, I will still finance myself using my assets, and you don't have to worry about all the stories you hear in the press about how we're not doing so well.
Yeah, that's very.
Originators.
That's very true, because I was part of that team, and between 2007 and 2010, despite being considered a Spanish bank, we managed to refi in securitization format 100 billion of assets across every jurisdiction Santander was in, whether it's Portugal, Spain, UK, anywhere, and we had no problem getting funding for the assets directly. We even did synthetic securitizations at the time for project finance and other assets. But it was much more difficult. The secure funding spread was much higher on the secure basis, much higher as a bank than the actual asset themselves. So for Santander, it was beneficial to just continue securitization in full mode. One question for you, Ian. You hear always this phrase, true sale, true sale, true sale. Can you explain what people mean with that?
So true sale is, and we're not going to talk about synthetics now, we're going to talk about synthetics later. True sale is basically how you achieve the asset-only risk. Because if the assets remain on the balance sheet and remain the property of the originating bank, and that bank becomes insolvent, then those assets, those mortgages, those car loans that you say you've securitized, will get trapped by law in the insolvency of the bank. There are laws in every country about when institutions and banks go insolvent, and everything is frozen, all payments of debt are frozen, all payments of debt are now pari passu, irrespective of original maturity. You can't dispose of the assets of the bank unless the liquidator disposes of them, possibly with a court order. And so if the assets stayed with the bank, you couldn't have an asset-only risk, because the bank goes down, your assets get trapped. So, and all this technology, by the way, comes from the United States from the very late 70s and early 1980s. So the way to get around this is you actually take those assets and you sell them. The bank sells the assets. That's legally what happens. The bank thinks of it as funding, but I used to be a lawyer. The legal event is actually a sale of those assets so that you can remove them, and it has to be a true sale. And what do we mean by true sale? It has to be a sale which in your country, under your legal regime and your insolvency regime, that sale is such that it cannot be reversed in an insolvency. That the liquidator of the bank, administrator of the bank, cannot claw those assets back. That's why that sale is a true sale. And so having sold those assets, you remove them from the bank and the bank's insolvency. So now the investors can fund the assets only. Now, here's the small technical problem, of course, is that once you've removed those assets from the bank, you have to put them somewhere. Like, assets can't hang in space with no owner. That's not how the law works. And so in order to put them somewhere, you don't want to put them in somewhere which is as risky as the bank, right? You don't want to say, it's great, I've removed these assets, these mortgages, these car loans from the bank, it's been sold, and I've put them in another bank or another institution that is equally at risk of insolvency. So you need to find a safe harbor, a safe haven for those assets once you've sold them from the bank. And that safe haven, that safe harbor is what we call the special purpose vehicle. And the special purpose vehicle is another term of art in securitization, is a company that has been set up for the sole purpose of that securitization. It does nothing else. It has no employees. It has no other debt other than the securitization debt. And therefore, it's insolvency remote. It's not insolvency proof, because all corporations can technically at law go insolvent. But it is insolvency remote. That special purpose vehicle should not go insolvent. It should be tax neutral. And as I said, it does nothing else but hold these assets and issue some securitization bonds. And that's why you call it a true sale securitization, because the assets are technically illegally sold from the bank to this special purpose vehicle that is used only for this one securitization and nothing else.
Okay. Thanks, Ian. You mentioned at the beginning two items. One is asset-only risk, and the other point was tranching.
Tranching, yes. Yeah.
Care to explain?
Yeah, so tranching, I don't know why it's called tranching. Tranching, tranche in French means slice, so I do understand why, but nobody's ever been able to explain to me why the Americans used a French word, tranching, for what should be called slicing, but there you have it. That's one of the mysteries of securitization. If anybody ever finds out, please send me an email. Tranching is the other thing about securitization. Like we said, asset-only risk. Investors invest in assets. They take the risk of the assets, timing risk of the assets, credit risk of the assets. But the other defining feature of securitization is tranching. So I said you sell your assets to an SPV, and the SPV buys those assets with money raised in the markets. But though that money is never, in the case of a securitization, raised simply from one loan, one bond. It is raised from a series of bonds, series of loans potentially, which are ranked in order of seniority. So you have senior bonds. I don't know if you want to show the picture maybe of the securitization. I think shows that exactly. This is it, right? You have a senior tranche. These numbers are imaginary, but you have a senior tranche. Let's say you've got a billion pool. You've got a senior tranche of 900 million. You've got a mezzanine tranche of 90 million. You've got a first loss tranche of 10 million. As I said, the numbers are imaginary. That first loss could be 15, mezzanine could be 30. It depends on your deal, depends on your asset, depends on the rating you're looking for. But this is a nice, neat set of numbers. And what this means is that your pool of assets, right? Those investors, senior tranche, mezzanine, first loss investors, are taking the risk of those assets, that billion pool. But they don't take them equally. They are ranked by order of priority. And that means that the first 10 million of loss on that pool of $1 billion is going to be taken by the first loss investor. If you have 10 million of losses on your pool of $1 billion, that first loss investor will lose all his money. When you get to the 11th million of loss, the mezzanine investor is starting to lose money. So if you've got 11 million of losses, first loss guy is gone, he gets nothing back. The mezzanine investor has lost 1 million, and the difference between 10 and 11. He's now down to 89 million, right? And it is not until you have losses of 100 million that the senior tranche investor starts to suffer loss. Now, what that means, of course, is that those tranches are going to be priced very differently. If I'm taking the first 10 million loss in a $1 billion pool, I'm going to want a hell of a lot of money to take that risk. That's a huge risk. So I'm going to want thousands of basis points. But if I'm taking the senior tranche, if you look at a pool of mortgages and then you do the analysis, right? Let's say it's $1 billion of mortgages. You look at the whole history of Greek mortgage lending and you look at what's the worst loss you've ever suffered in the worst crisis you've ever suffered. If that number is 50 million out of $1 billion, right? If it's 0.5%, then you're going to say, well, frankly, the crisis would have to be twice as bad as the worst crisis ever suffered in my country before I, as a senior tranche holder, lost even €1. And that's an incredibly safe bond. And by the way, this is why in the crisis of 2008, and then in the crisis of 2012, the sovereign crisis that followed, in the traditional asset classes that are the subject of securitization, car loans, consumer loans, SME loans, mortgages, not a single senior tranche investor anywhere in Europe lost a single euro of that investment. Even through the crisis that Greece and Spain suffered. I mean, in Spain, peak to trough property values, residential property values, dropped by 70% in the crisis of 2008 and 2009. Senior tranche investors in Spanish RMBS lost zero. And that's why, if you're a senior tranche investor, you can price that very tightly because you're taking very little risk. And tranching is the other, with asset-only risk, tranching is the other hallmark of a securitization.
And I mean, as you said, the lower the tranche in the stack, the higher the risk, the higher the tranching, the lower the risk. But saying that, as I said, as an investor, I saw that despite having lots of assets, as you mentioned, in this periphery, even Ireland as well, I never had to take a loss. I only had to do is a time delay in repaying, okay, and I had to take time extension, but not an actual loss. And when the market did recover, I was able to dispose those positions to another investor at effectively par price. So, this is, I think, the other story or kind of conclusion from securitization crisis or the financial crisis, that if the deals are structured properly, then even something like the sovereign crisis we had in Europe was not enough to break those deals, right? This shows you how strongly those deals were structured, right? And
now, there's a question here about non-performing loans and thinking of securitizations of non-performing loan as a de-risking solution for banks. And the person who asked the question says, they are an opportunistic punt by investors. I think that's actually not quite right. So if you want to show the tranching again, this one, or actually the red one. So you're quite right. Non-performing assets is a slightly different market, but fundamentally, it's exactly the same. I said asset-only risk and tranching. In non-performing assets, this is exactly what you have. So the bank sells the non-performing loans just like it sells consumer loans, just like it sells mortgages, and the investors invest. The difference in non-performing assets is nothing to do with tranching or asset-only risk. The difference is where those lines in that particular slide are drawn. In my example, for example, I had a first loss at 10 million, which might be okay, for example, for a very safe mortgage pool. In NPLs, that first loss is not going to be 10 million. That first loss in an NPL transaction is going to be potentially up to 600 million. If the bank is holding those NPLs on its books, it's $1 billion of face value, but actually it's already written off a loss of say 500 million. Then if it'll do a securitization, that senior tranche might actually only be 300 million. And then the mezzanine tranche will be a couple of hundred million below that, and everything else will be the first loss. The difference there also is that the first loss will be kept by the bank. So instead of having an investor, you could find an investor, but since they're NPLs, you're unlikely to find an investor for the money that you've already written off. So what you see is that the first loss in this situation is kept by the bank. But there is nothing fundamentally different about an NPL securitization than there is with a normal securitization, other than where the tranching is. And I think in that sense, to say it's an opportunity punt by investors, I know a number of investors in NPLs who think that's not quite what they do. What they do is exactly the same as somebody who buys a prime quality mortgage pool. You look at the data, you look at the country, you look at the underlying assets, you work out how much you think you're going to lose. The difference is that when you're an investor in really high quality mortgage pools, you're looking at, are you going to lose 50 basis points or 75 basis points if the crisis gets bad? Could you lose 100 basis points on that pool? And when you're doing the analysis on a pool of NPLs, you're thinking, am I going to lose 60% or 70% or 75%? But it's the same analysis, it's the same approach. So I genuinely do not think there is anything fundamentally different conceptually between the securitization of a pool of high-performing assets and NPLs.
I mean, Ian, I've said many times to many people, we are not doing alchemy, right? I mean, securitization is not alchemy. It doesn't turn bad assets into good assets. There's always a part of the assets that you don't know what they are, and that part of the assets you can say they are safer than the rest. But that's just tranching the risk. It doesn't change the risk. It doesn't increase the risk. It doesn't decrease the risk. It just separates the risk and kind of spreads the risk to different investors. But the total amount of the risk is always the same, right? That nothing changes there, right? I think for the interest of time, we should.
Yes, we need to.
Yes. I mean, as an originator, right? When I was an originator, as Ian mentioned, and when I was at Santander, at that time, it was probably the only way we could get funding at a reasonable price. Not only that, we actually managed to find, during the crisis, investors who were willing to take also the first loss piece in assets that they considered to be of their appetite, and therefore we managed to get some, let's say, capital management through that process. So, because the investor says, look, I'm not sure I want to finance the entire Santander operation across the planet, especially Latin America. I'm not sure about that. There's too much uncertainty, but I'm very happy to finance some of your assets in some of the jurisdictions and feel comfortable. And that's exactly what we did. And then, of course, as the crisis unfolded, the tranching in several jurisdictions became thicker. So the first loss piece before the crisis, for instance, in Italy was 4 or 5%. Following the crisis, it went to 10, 12%. But still, for the senior parts we were trying to finance, and we were only selling the senior parts, for the senior tranche, we still managed to find at a very reasonable price investors, and we could finance the operations and continue asset lending. We adjusted our lending spreads, and therefore we continue to have a margin on the business, and the business continued. Because as I said at the beginning, you originated originally assets at 100 basis points, then you originate at 200, you finance them at 100, you lock in the spread of 100, and you still have the same spread as before the crisis. It's just different starting point for your liabilities and different starting point for your assets, right? So
yeah, I mean, there is a concept of excess spread, which is that you can sell all your assets in a securitization. You can even have investors take all the risk, but if you add the sum of the senior, the mezzanine, and the first loss coupon, that coupon can be less than what you're getting on the assets. And that has to do with the difference between wholesale and retail pricing, right? As you said, securitization is not alchemy. The overall risk after securitization, whether it's mortgages or NPLs, from the highest quality to the lowest quality, the risk remains exactly the same. But you can, for a mortgage, you can charge more in the retail market as a bank than the cost of financing that risk in the wholesale market. And therefore, if you've got the markets financing if you add the financing costs of the senior, the mezzanine, and the first loss tranche in the wholesale market, it is quite possible that you will still be left with an arbitrage versus the cost of basically, or the cost you can charge that book at in the retail market. Now that depends on the asset, the country, the time, it depends on a lot of things. But it is originated in the United States, that's how securitization works also. That wholesale retail arbitrage means that you have sold all your assets potentially, including the first loss potentially, and yet you're still making money from assets that are no longer yours as a servicing fee because you continue to service the assets. The result is that you have an infinite return on equity, on assets. So yes, that also is another advantage for the originator on top of match funding. And if you are able to transfer all the risk, and this is a very complicated area, but let's just speak conceptually. If you're able to transfer all the risk, then you need not put any capital against it, because capital is there to meet risks on assets. That's why Basel capital requirements are a percentage of your risk-weighted assets. If those risk-weighted assets have now been transferred, the risk has been transferred to the securitization investors, you can then go to your prudential regulator, and it's a lot more complicated in reality than just saying it on concept. But you can go to your prudential regulator and say, I have lost all the risk on these assets. I don't need to allocate any capital against it. And so it becomes a capital management tool. And in fact, when securitization started back in the 70s and 80s, it was very much in the United States, and then in Europe, when it came to Europe, it was very much a capital management tool. It was a way to generate assets, move them off your back with some capital. You had 10 years of capital, you generated 1,000 euros of assets, and then you basically 10 years of capital, 100 euros of assets, more realistic. And then you basically moved that 100 euros of assets off your balance sheet, you kept that capital, and then you recycled that capital to generate another 100 million. And so you could manage your capital that way and recycle the capital through securitization. So it's also a capital management tool.
Moving quickly, and because I think we are running behind time. As an investor, I mean, the one way to, let's say I wanted to invest when I was at ING in the Netherlands, I wanted to invest in SMEs in Greece. Two ways to do it: set up a bank in Greece, start originating, do the whole platform, hire a team for administration, servicing, etc., or I could decide and invest in a mezzanine or senior tranche, depending on my risk appetite, in a transaction made by another by somebody else. So that's the main reason for investors. Basically, when you want to have exposure to a market, or you like the spread in that market, and you want to diversify your asset base, and the easiest way to do that is by effectively buying somebody else's securitization tranche, right? I think that covers it. I think we have one more question on NPLs, and I think after that we should move on to the synthetics, because I think that's also very important. Ian, do you want to cover that?
Which one?
The NPLs, demand active servicing, and there's the second one. Sorry, yeah.
Yeah. So again, I think that's a question of quantity, not quality. So what I mean by that is, conceptually, a mortgage pool demands active servicing. Right? Money doesn't come in on a mortgage pool. People forget, you have to chase them, etc. You have to make sure you collect the money. There is servicing in all securitizations, and that servicing is almost invariably conducted in traditional securitization by the bank. In NPLs, the quantum of servicing is much greater, much greater. And that is a fundamental, it is a big difference with NPLs. But it's not a difference of kind, it's a difference of size or quantity, I should say. So in that sense, again, NPLs are no different from mortgages or car loans on a conceptual basis. What also tends to happen in NPLs is that the relationship between the original bank lender and the customer has broken down, because guess what? It's an NPL. So he's not paying. So what you often find in NPLs is that the servicing is taken over by someone else. So someone else has bought those those NPLs, has financed in the securitization market, and is taking the servicing because that's their way of extracting profit. Basically, you can get your securitization out at a certain cost, and you can do, let's say, 600 million. You leave the bank with 400 million of losses, but it's still a billion pool of face value, and somebody's buying it because they think they can probably actually do better than 600 million in recoveries. And the way they do that is that they take over the servicing and try to get, say, 65 million, and the 5 million stays. So in NPLs, you often have the servicing move, whereas you don't in a normal mortgage car loan deal, because of course those are performing assets and the bank doesn't want to lose the relationship with the borrower because it's an ongoing and good relationship. He's not an NPL yet. So there are some changes, there are some differences in style, there are some differences in how the markets tend to operate. But conceptually, intellectually, fundamentally, they are the same. The way securitizations work, be it in NPLs or in high quality mortgages, is fundamentally the same.
Okay, thank you. I guess I don't think we have any more questions on that. You mentioned at the beginning that a fundamental feature of securitization is true sale, but that's not always the case for all securitization. I think
that's
there's
right. So basically, synthetic securitization, which is also known as on-balance sheet securitization in the regulations that have just been passed, is a form of securitization without true sale. And that sort of makes it difficult to be compatible with asset-only risk and so on. It's interesting to understand the genesis of synthetic securitization. So synthetic securitization doesn't have any true sale. The assets remain with the bank. Originally, this was done for a number of reasons, either because you lived in a jurisdiction where transferring an asset was extremely costly. There was tax possibly on the transfer of the asset, which would destroy the economics of securitization, or because transferring an asset on a true sale basis only could be done if you notified the underlying borrower, and banks would be very wary of telling their borrowers that they sold the asset, they sold their mortgage, or even more sold their corporate loan. And so because of those, sometimes there was tax reason. In Germany, for example, did a lot of synthetics because there was an old tax problem with true sale, which has now gone away, but back in the 80s, this was a big thing, Gewerbesteuer. So then clever investment bankers try to figure out, can I do a securitization without a true sale? And there are ways to do that. And so and I'm not going to take you through how they did it because it gets very complicated very fast. But basically they tried to replicate this and they called their product synthetic securitization. From that source, from that origin, synthetic securitizations drifted away in how they were done and why they were done from true sale securitizations. I said true sale securitization started at capital management tools, but over the 90s and the 2000s, early 2000s, there were changes in accountancy and there were changes in regulation that made it more and more difficult to really use true sale securitization as a capital management tool. And so true sale securitization started to drift into a funding instrument. It was just a way of cheaply funding, match funding, and funding when you had difficulties raising money on your own name. But it became a funding tool with no capital benefit. Now, interestingly enough, capital is coming back to true sale securitization. Again, a whole variety of complicated reasons we won't have time to go into today. But so there's more now capital management, true sale securitization. For a long time, true sale securitization just drifted into a funding system. Synthetic securitization drifted the other way. Synthetic securitization basically drifted into pretty much only a capital management tool. And synthetic securitization basically is a form of credit insurance. But it's still securitization because you've got tranching. So what you have is a group of investors, who are also known in the case of synthetic securitization as protection sellers, who basically agree that there is a reference pool, which is basically the pool that is sold in a true sale securitization, but in this case is not sold. There is a reference pool, and there are the tranching comes via what's known as attachment points and detachment points. And so you may have three categories of investors, just like a normal securitization: the senior investor, the mezzanine investor, and the junior investor. The junior investor agrees that on the reference pool, he will pay whenever there's a default on that pool, and he will pay the first, to use exactly the same numbers as we did before, the first 10 million he will actually pay. So his attachment point is 0 and his detachment point is 10. The mezzanine investor says, if you start to suffer losses on the reference pool that hasn't been sold, then we will pay from 10 million to 100 million. So we've got a 90 million difference between our attachment point and detachment point. And then the senior investor will say, I will pay everything above. So in that sense, so far so good, so far like a normal securitization without the true sale. But it works as a form of insurance. So I suffer a loss, I, the originator, suffer a loss on that reference pool, you, the investor, pay money to me. That morphed, if you want, that evolved over time to a position where the first loss and the mezzanine were the only things, they were the only tranches of the securitization where you actually got an investor. Because synthetic securitization became pretty much entirely a form of capital management, economic capital, but more often regulatory capital. And if you think of capital as meeting the requirements for expected and unexpected losses, in fact, technically expected losses should be met out of the cash flows of the assets. Unexpected losses should be met out of capital, which are the first loss and the mezzanine loss, effectively. Then if you insure that, you should be able to go to your prudential regulator and say, I don't need to have any capital now against that reference pool. And the senior, you could sell the risk on the senior, but it doesn't happen. Virtually no one does it. It could, but no one does it synthetically. So a synthetic securitization has tranching and it has asset-only risk. The investors only pay if the assets default. But they don't have true sale, and they are used primarily, if not exclusively, for capital management purposes.
And how do you actually do that, Ian? How do you manage your capital? I mean, there's regulation.
So, yeah, and this is where I know that in the agenda we talked about the regulatory structure. So this is the regulatory structure. They are, there is a complexity, which is that the rules on capital are defined by the CRR in Europe. So capital, the capital requirement regulation, sorry. The CRR. And the CRR is extremely complex. I think it's about 700 pages long and gives most people brain hemorrhage if they try to read it. But the CRR says you need so much capital against your risk-weighted assets. The CRR has special capital requirements if you hold, as a bank, as a regulated prudential bank, if you hold securitizations. There is another set of rules that exist in the CRR called the significant transfer rules. Significant risk transfer rules, sorry, SRT. So CRR tells you how much capital you need against those assets. You say, I've got a synthetic securitization. I have sold the risk, I've insured effectively the risk through my securitization of the first loss or the mezzanine. So therefore, I want no capital against that position, or I want reduced capital against that position. The prudential regulator is concerned that you may actually not really have transferred the risk. Yeah, you've got a contract for a synthetic securitization, but you may be playing fast and loose with the rules. You haven't really lost the risk, or there's still a lot of risk that you've kept. Maybe you've kept duration risk, maybe you kept basis risk. So the prudential regulator, via the CRR and via an awful lot of guidelines and RTSs, that's regulatory technical standards, has said we are going to have very complex rules around significant risk transfer. You, the bank, are going to have to show me that your synthetic securitization, and by the way, SRT also applies to true sales securitization, but that your securitization meets all those rules before I tell you that you can reduce capital. And the rules are basically a quantitative test and a qualitative test. The qualitative test says your securitization has to have all these features to make sure that qualitatively you have removed risk. And the quantitative test tells you how much of the risk you have to remove through your securitization before I give you a capital benefit. And if you meet the qualitative test and the quantitative test, then your prudential regulator will tell you your securitization achieves significant risk transfer and you can get a capital benefit for it. Those tests are exceedingly complicated in all directions.
And how do you structure those things? Are those funded, unfunded? I mean, what is the form that such a SRT would have to take for you to
so how do you do this securitization without a true sale? There are basically three classic ways of doing it. One is to get a guarantee. So your investor, instead of buying a bond, your investor issues a guarantee. And it says, to take out now, canonical numbers, first loss is 10 million, second loss is from 10 to 900, 10 to 900. Senior is all the way up to billion. So 90, 10, 90, and 900. So in a very classic guarantee / insurance, your investor says, I will guarantee any losses on that pool of $1 billion above 10 million, all the way up to 100 million. So 10 to 100, I take 90 of risk. Through a guarantee, very normal. And in exchange, you will pay me a guarantee premium. So the bank says, in exchange for you guaranteeing those losses, I will pay you every quarter an amount of money, which can be seen as a coupon, as an interest rate. That's the first way. The second way is a credit derivative, usually a credit default swap, where basically, on the one hand, the bank agrees to pay on one leg of the swap the premium, and as the second leg of the swap paid by the counterpart in the credit derivative, which is the investor effectively, that investor, as the second leg of the swap, promises to pay whatever amount you have lost above 10 million and below 100 million. The third way of doing it is a credit-linked note. A credit-linked note is actually a bond. So there, you issue bonds to the tune of 90 million, i.e. between 10 and 100. You issue 90 million of bonds, but they're very special bonds. They're limited recourse bonds, which means that if you suffer losses above 10 and below 100, then the bank doesn't have to pay you back the full 90 million. It only pays you back 90 million minus the losses suffered. So it's a limited recourse note, but it's actually a bond. If you do a note, of course, it's a bond, so you have to pay some money. And then you have a funded transaction.
Thanks, Ian. I mean, we have, I think, about 18 minutes left to go through the remaining of the presentation. So I think we're going to accelerate. I mean, there's the handout is given so people can see, everybody who participated can see all the slides. But I think people want to understand the story of STS, how we got there, what is happening. So if you don't mind, I'll accelerate that process.
Sure. And by the way, we were never going to go through all the slides. There's hundreds of slides. The slides are there to people to take away and read at their leisure. As they said.
Yeah, you mentioned crisis is what led to the STS and how we got there, right? I mean, this is a timeline that we already briefly spoke about and what the STS is all about. I think, the recent regulation that just came out a couple of months ago included synthetics. And I think that's where the structure starts. We mentioned about CR and the various rules and the benefits of STS. So do you want to talk about what is a role in this part in the STS, and then we can talk a bit more about the changes that came through and what is most banks see as an issue when they do the first STS, what is the biggest hurdles they face regarding that, and what's the benefit of synthetics?
So basically, I think we need to go quickly through what is STS. As I said, after the crisis, we talked about this when we talked about why PCS had been set up. After the crisis, basically regulators decided to really punish securitization. One of the ways to punish securitization was via the Basel Committee, and we can talk about that, but we don't have the time. Via the Basel Committee decided to massively increase the capital required for any bank holding a securitization position. Massively. In such a way that for many good quality product, it would have been impossible to sell to a bank. And by the way, the European Union did the same for insurance companies buying securitization, massively increased the capital required by an insurance company to buy a securitization. The market pointed out that a lot of securitizations had performed extremely well. And so the deal was struck between the market and public authorities to say, okay, if we can define the kind of securitizations that did really well, then we are willing, the public bodies, we are willing to give you a lower capital requirement for those really good quality securitizations. And that's the STS regime. Between 2014 and 2017, European Parliament, member states, everybody worked together, regulators, to define a kind of securitization that really was high quality based on the things we'd learned during the crisis. And that is the STS, Simple, Transparent, Standardized. Simple, Transparent, Standardized Securitization is a securitization that meets criteria that are set down in the regulation. There's 103 of them for true sale. So it's not easy, it's not simple. But if you meet all 103 specified legislative criteria, you can call your securitization an STS securitization. And in exchange for that, the regulators and policymakers give you a lower capital requirement as an insurance company or as a bank. It gives special treatment for incorporation of these STS securitizations in the liquidity cover ratio pools. It gives some benefits to money market funds too. So that's the essence of STS. You meet the requirements, we'll give you some capital benefits. Originally, synthetics were not part of that law that was passed in 2017. People said you should have lower capital requirements for synthetics that meet the requirements. So the European Commission went back and created an amendment to the STS regime which incorporated synthetics with some additional criteria. So synthetics now have 145 to 160 separate criteria to be a synthetic STS. But if you meet those 145 to 160 criteria, again, you can have lower capital against that securitization position.
But I'm given requirement. It was difficult to monitor, right? That you read everything. So the regulators thinking, okay, what can we do about it? Because self-regulation didn't really work for banks, right? And that's,
yes. So our position as third-party verification agent, yes, comes from this concern. The narrative, whether it's true or not, is subject to some discussion. But the narrative was bad bankers had basically lied, and therefore STS, which required bankers to conform with certain rules, was a problem because how could you make sure that the bankers didn't lie again? One way to do that, of course, would be to the regulators could themselves verify all STS securitizations. The entire regulatory community in Europe said no, except for one regulator who said, oh yeah, we'll do that. But everybody else said, we are not going to verify this for political reasons and complexity reasons. And so it was less, and the other persons who could verify it, of course, were the investors. But as I said, there's 103 criteria in true sale, 145 in synthetics. And the investors said, listen, I already have to do so much additional work to buy a securitization. If on top of this, you require me to check 103 additional things in every securitization I buy, I am not going to buy any securitizations. And remember, STS was designed to revive the securitization market. The investor community said, we're not checking that stuff. Regulators said, we're not checking that stuff, which sort of left the legislators with, oh, well, in that case, it's going to be self-regulated again by the banks, and we don't want that. And so they came up, well, they didn't come up, we came up with this compromise, which is, okay, have third-party verification agents, independent bodies, subject to regulation, subject to control of their conflicts of interest, subject to codes of conduct, have those guys verify STS. Now, for complicated political reasons, this was not made mandatory. There was a discussion as to whether it was made mandatory or not. In the end, the legislature, the parliament wasn't keen on it being mandatory. So it became optional, but originators can get third-party verification agents to verify that they conform to STS, and that allows the investors to rely on that verification, and therefore they don't have to do individually the 103 things, which of course socializes the cost to the investor community of checking STS. So that's sort of why we're here and why we think it makes a lot of sense.
I think, Ian, unless we have something else to add about that, I think we can have a little 5-minute, let's call it coffee break. During that time, we will answer questions that have come through in the first part. And then we'll continue with the second part, which is to talk a bit more about the synthetics, the STS regime, and the synthetic STS regime. A couple of questions we have are regarding NPLs. One of them is, do you believe that establishing a central data hub at EU level for NPLs will enforce common reporting templates and facilitate securitization? That would increase transparency and subsidization, I guess, in the EU market. What's your view on that?
Yes. The simple answer is yes. The slightly more complicated answer is that ESMA has a very bad track record of creating sensible reporting templates. So I would say that in theory, yes. And I know a lot of people who play in the NPL markets, particularly the kind of American and hedge fund type organizations, don't like that idea. I think because they see some of their qualities or some their competitive advantages is in the opacity of the information and their capacity or the self-perceived capacity to get through that opacity. But actually, no, our view is that yes, a central data hub with reporting standards, as long as those reporting standards are sensible, and that's of course a big question mark, because as I said, ESMA has bad track record there, but sensible reporting standards will help NPL securitization, yes, absolutely.
Okay, thank you for that. The second question is, can the STS framework could be further enhanced to facilitate the growth securitization market, and can the process of transferring risk be simplified?
So let's two-part question. What's wrong with the STS standard is not the STS standard. we and many other people, including 2 independent commissions set up by public policymakers, came to the same conclusion. What's wrong with the STS standard? The reason the STS is not working to revitalize securitization is it's never been achieved, it's never been finished. It's a half-done reform. So the European authorities did a good job, in our view, in creating a standard. The standard, complicated, yes, 103, but basically workable. We're at 500 deals now notified to ESMA, so it's not like it's not workable. It clearly is workable. The problem is not there. The problem is, for that extremely high and well-regulated standard with sanctions regime, independent third-party verifications, 103 criteria, what you got for that incredibly high standard of securitization are CRR capital requirements, LCR rules, Solvency II for insurance company capital requirements that are still orders of magnitude higher than they should be. You have created a pristine, you being European policymakers, have created this extremely high quality, pristine instrument. It's an instrument which you can go back to the crisis of 2007, 2008, and not a single transaction that at the time would have been STS, not a single one of them suffered a single euro of loss in the senior tranches, not one. That's an incredible performance in the middle of the worst crisis we've had since the 30s. And yet, you still have disproportionate capital requirements in CRR, disproportionate rules in the LCR requirements, and disproportionate capital requirement rules in Solvency II for insurance companies. So that's what we need to change. We don't need to change the rules for STS, they're fine. What we need to change is the benefits you get from STS, because those don't reflect the quality of the product.
And I mean, it's fair to say that currently the annual, as you mentioned, review is coming up. Of course, the first record joint ESA report was not what the market expected, but that still there is still room, let's say, because they passed the ball to the EU, the Commission. There's still room for the Commission to actually give those benefits and improve, let's say, the proportionality of capital to the requirements of the asset class.
We've been told that in the next few weeks, the European Commission will issue a consultation on securitization and LCR and CRR calibrations.
Excellent.
Which is, well, it is the European Commission's tradition to issue consultations just before the holiday period with deadlines which end just after the holiday period, which means that they have a good time. They can go on holiday while all of us in the markets have to basically work on it during our holidays. They will also usually do the same mid-December and launch a consultation with a second week in January deadline.
Okay. Now, before we talk about the synthetic STS regime and what it brings and why is that for several banks, a lot of analysts have described, I mean, if you look at the banks' book to ratios, to equity ratios of 30s and 40s and 50s, the only way to give value to shareholders is to start managing your capital. And as we mentioned, securitization can be an excellent capital management tool because, let's face it, with those book to equity valuations, if you're raising capital to meet the Basel 3-4 requirements are coming, it's going to be a very high task unless you keep all your profits to build your capital organically, but then the share price will probably tank as a result of that. So it's a conundrum that most banks are facing. So they need to optimize the capital, given that funding is, there's more funding than anybody needs at this stage. Do you think makes sense to talk about a bit the structures of the synthetics, or we should go straight to the regime and not go back to those slides with the structure of the synthetics and how does it work? What's your view?
No, I mean, it really depends on our host in terms of timing, but so I leave it up to you. I mean, the structure.
We have about 40 minutes before Q&A, 45 minutes.
Yeah. So I would skip that. I mean, the slides are there. I think they're fairly self-explanatory, so you can go to those slides and see how synthetics are structured, how they are made to work, and that's actually quite interesting. But I think we should go to the synthetic regime, STS regime. The point you make, of course, is crucial. As I said, the synthetic STS regime is all about capital. The regulators made it all about capital too. Basel III, there are many, many numbers that are circulating around about how much additional capital needs to be raised by European banks to meet the Basel III requirements, or Basel III and a half, whatever you call them these days, come 2022. And but the numbers on the low side of around 165 billion euros of additional capital to be raised across Europe to maintain the same level of lending. I've seen numbers at 200 and 225 billion, but nobody's putting that number at 5 billion, right? It's whatever the number is, different calculations. It's a very substantial amount of money. Banks have a difficulty explaining how they're going to basically generate substantial returns on capital. If you look at the pre-Great Crisis, return on capital of many banks is quite high, but that's because they did a whole bunch of activities that are no longer allowed, or where the capital requirements to play in those games has been raised many folds, making it very difficult to be profitable. So the result is we do have this huge problem in Europe about how banks can raise capital in that quantity. And if they don't raise capital in that quantity, they have only two options. One is to stop lending, or at least restrict their lending to match the capital they have. And the other one is to use securitization as a capital management tool, either synthetic or true sale, or both. But those are the only options. And when we're talking about these numbers, 165 billion, 200 billion, this doesn't even account for the European Commission's and the European Union's Green Plan. The European Union Green Plan is envisaging an extra 376 billion in lending every year until 2030. Right? 376 billion every year till 2030 of additional lending beyond what banks currently lend to. I mean, may not be banks, maybe capital markets instruments, but beyond what is currently being lent for cars and mortgages and SMEs and companies, etc. An extra 376 billion. So that's yet more banking capital, or yet more problems for banking capital. And therefore, securitization really is going to have to start playing a major role if we want to be able to meet those numbers.
Yeah, and I have to say, I work on both sides of the Atlantic, and what I found always amazing about the US is that the banks, as soon as they originate an asset, they say, does it make sense to hold it on my balance sheet? What's the capital required? Which part of the bank asset I should hold? What doesn't make sense? I will straight it, syndicate it, sell it, securitize it, get it out. And as a result, you see US banks originating half of the profits through lending and half of the profits through intermediation, effectively recycling the assets. As a result, you have a very developed capital markets in the US, and banks can raise capital because the returns on equity are around 15, 16%. You look in Europe, very little syndication, very little recycling of assets. As a result, banks' ROEs on average are between 8 and 10%, high single digits. And you don't see the capital markets being developed because the assets are not recycled into the system. You don't see those investors who would take specific risk, because don't forget, synthetic securitization or securitization allows investors to take very specific risks according to the risk appetite. But that is changing, right? And I think last time around I spoke with one of the biggest synthetic issuers in Europe. He told me that he now has between 75 and 100 investors willing to look at different jurisdictions, different asset classes, different risks, to buy specific tranches from a transaction, synthetic or cash, to provide effectively capital to the banking system, but only targeted capital, right? And that's what I think is where it's going to, right? Targeted capital.
Yes, I mean, basically, this also plays to a bigger worldwide issue, which is the surplus of capital and the lack of investable assets in which it can go. And that has, that's Larry Sumner, and it has a lot of issues around that, which are far too large to deal with in this talk. But But there's no doubt that we have a lot of money. The one thing that we do have in Europe is a lot of money. We have an aging population that's been saving for its retirement for a very long time. What we don't have in Europe is things for that money to go, places for that money to go. So let's go back maybe to the previous slide to explain synthetic securitization. To understand the issue of STS synthetic regime and why it's there and how it can help, is you have to understand the non-neutrality principle of securitization. The Basel Committee decided that securitization intrinsically creates risk because it's securitization. Many of us disagree with that position, or think that position needs a lot of nuancing, to say the least. But so the result of this is that, we talked about first loss, mezzanine, senior. If you have a pool, we said securitization is not alchemy. The risk is the same before and after, but not for the Basel Committee. The Basel Committee takes the view that if you have a pool of X, on your balance sheet as a bank, you will need to have capital allocated against that pool of KX, right? If you tranche that risk between an A, a B, a C, so let's say senior, mezz, and first loss, just like we've discussed, and you sell or even keep that securitization to other banks, so one bank buys the A, another bank buys the B, another bank buys the C. Conceptually, you would expect that the capital required by the bank buying the A, the B, the C, when it's all added up together, the KA, KB plus KC should be the same as KX because it's the same risk. The Basel Committee decided that's not the case. They are extrinsic risks of securitization. The very act of securitization creates additional risk, which are described as agency risks. Therefore, securitization is punished. KA plus KB plus KC is invariably larger than KX. Now, what does that mean? And again, this is not the time we can go into this, but we can explain why we think this is fundamentally wrong. And there's something called the P factor, which we think is fundamentally wrong. But what does that mean? If you want to show us a classic, if you've got a slide showing the classic synthetic securitization with the tranching.
Yep, 1 second, I'm putting it up. Slide 30.
Yeah, that one. Okay. So, actually, no, sorry, you're right. The previous, apologies, guys. The previous one was the attachment, exactly, this one, right? So let's say this is your synthetic securitization. You've got a pool of loans, and you have decided that you are going to sell the unexpected loss, attachment point, and you've got the tranche, and you've got your investor who's happy to take that risk. Before, you had the whole pool risk. Now, you may keep, let's say, the first loss, and you keep the senior note, the top, what we call the apocalyptic loss. But you've lost the unexpected loss, which is, by the way, the thing that you get capital allocated against, right? It's capital in the rules is there to meet the unexpected loss. You would think that the capital you as a bank now need to hold against this pool is dramatically reduced because you have sold the risk through a synthetic securitization of the unexpected loss. But non-neutrality destroys that possibility. Why? Because when you sell through a synthetic securitization the unexpected loss, you found somebody who's willing to cover the entire of the unexpected loss, you've done something else. You've now created a 3-tranche securitization in your books. Right? You've got the first loss, the expected loss, the first loss, the unexpected loss, the mezzanine loss, and the senior risk, where you're not going to get any losses. That is a securitization for the rules. And KA, the capital allocated against the senior risk, because of non-neutrality, is much greater than if you kept that loss as part of the pool without doing a securitization. Remember, KX is much smaller than KA plus KB plus KC. So you've lost in your capital calculation as a bank, you've lost KB because you've sold that risk. You still have KC, which is the first loss, and KA, the senior loss. But KA plus KC is nowhere near the reduction you would expect from selling KB. And KA can be so high that in certain cases, you have sold all the risk of the unexpected loss. But by keeping KC and KA, the capital you need is greater than the capital you needed before you did the securitization. So you've lost the whole mezzanine loss in your pool is now gone. The whole mezzanine risk is now gone. You need more capital than you did before. It is so absurd that the regulators had to put a special rule capping the capital, saying that if you did a securitization, SRT securitization, you could not end up with more capital requirements than before. But that's had to be an exception because that's what happened. And that's why the synthetic STS matters, because that senior tranche, if it is just a normal securitization, needs a normal KA under the CRR. And that is very, very high because of the operation non-neutrality. But if you agree that synthetics can be STS, then you, the bank, are now holding a senior STS position synthetically. And therefore, you can now benefit from the lower capital requirements that is available to STS. And that makes a lot of difference. I mean, Harry, you know those numbers better than me, but if you want to take people through those numbers.
Yeah, I mean, you take a classic synthetic transaction where a senior, mezz, and junior, as in this example below, and you put the risk weight under the STS rules, you will see that the capital for the senior tranche, despite being 880, let's say, million euros, the capital is around 7 million euros. The junior tranche being 20 million euros, the capital is 101, so it's 20, and the mezz is somewhere in the middle, around 50% of that. Even if you assume that you can sell the senior tranche at a very low cost, let's say 20 basis points, that's the protection you're going to apply, the guarantee you're going to pay for. And you sell the junior at 10,000 basis points, at 10%, so disproportionately higher. If you look at the total amount of interest you're going to pay for the senior tranche, which ends up being about 1.8 million per annum, and the interest you pay for the junior tranche, it ends up being around 2 million, assume a 10%. You will see that the cost of interest you will pay for the senior and the junior is it's almost the same. It's very similar, 2 million one, 1.8 for the other. But then what is interesting, everybody say, oh, selling the junior is very expensive. You have to pay a 10% coupon, and selling the senior is not expensive. You only pay 20 basis points. The capital released for the senior is only 7 million. The capital release for the junior is 20. If you do a cost of capital analysis and the cost of capital release, selling the senior tranche or buy protection against the senior tranche, you'll pay a 20% coupon if you look at it on a capital basis. And selling the junior, you're going to pay 10%. So selling the junior or even the mezz is much, much cheaper, is much more efficient. And that's what we're seeing now with the STS, synthetic STS regime. Most originators keep the senior because that's what the rules say, and I think we're going to go into that in more detail in a minute. But the rules say keep the senior, the capital release is very little, the cost of that is very expensive, get rid or buy protection for the junior because that's effectively the cheapest form of capital you can raise. And that's what we are seeing, and we are working on several transactions across Europe right now for that. Following the STS transaction where the risk weight has dropped from 20% to 10%, has made that analysis and that kind of calculation even more favorable. And effectively, the same amount of money or interest you will pay for the junior, you pay for the senior. Therefore, everybody decides to sell the junior and keep the senior. And I think I'll pass it on to you. Yeah. Continue.
That's right. By the way, there is a question there about COVID initiatives providing a first loss protection of 80/20 as a guarantee, and whether or not you can treat them as a synthetic securitization, synthetic transaction, and get capital relief for that. It's a very interesting question. I had the same question for a French bank a couple of weeks ago, a week and a half ago. I don't know the answer. Sorry.
Well, I actually work with that in Belgium, because when I was in ING, we did a transaction in Belgium, one in Holland, and depends on the way the regulation is drafted. If the regulation is drafted as two tranching and you have tranching, then you have to follow, and that's what the Belgian Royal Decree did. And because the Royal Decree in Belgium forced the tranching to be 5, 7, and the rest being the senior, that did not always match the actual tranching, and nobody actually issued out of the scheme. If it's more like the Dutch scheme or some others, where it's just a guarantee on the losses, there's no tranching. They say when losses hit, I'll just repay you back 80% of those. So, and again, that is not a tranche, because it's not the first 20% we pay, the next 80 you take. It's for every euro of loss, it's a pro rata instead of, let's say, sequential loss, right? So basically, for every euro of loss, 20 is taken by the government, 20% is taken by the bank. So the losses are parallel, not sequential. And therefore, in those schemes, that is not a securitization. So it all depends how the law is drafted, and each country is slightly different.
And I think there's also a policy element, which is, your prudential regulator. It's not very clear, at least to us. We certainly haven't heard. We've heard lots of banks ask the question, but no bank has provided an answer. That whether the prudential regulator is prepared to give capital relief for, government guarantees around COVID. We shall see. But it is a very good question, and it is not the first time that I have been asked that question by somebody in the market.
I think, Ian, if we talk about synthetic STS, I mean that what the synthetics did is added to the existing criteria some additional criteria, as we mentioned, right?
Yes.
Please.
Yeah. So it's interesting to see what they did, and the STS synthetic regime is a little bit like a Frankenstein monster. It's got body parts sewn together from very different sources. The true sales STS regime is very much, we talked about why this was put in place, is an investor protection measure. It is there to define securitization that investors can buy relatively safely. And if you look at the 103 criteria, we can disagree with some of them or agree with all of them or whatever, but if you look at the 103 criteria, it's clearly they all come from this investor protection measure. You could have created a synthetic STS regime as an investor protection measure and therefore used only investor protection criteria in the STS regime. The EBA, even though I had many quite strong discussions with the EBA when they were crafting this, and we had a lot of sit-down meetings with them about this, the EBA decided to hijack, and they know that that's how I feel about it because I've told them. They decided to hijack the STS synthetics because, as I said, the STS synthetics is about the senior tranche and the originator keeping the senior tranche, capital weighing the senior tranche. And so the EBA decided that they were going to insert in the STS synthetic regime a whole bunch of SRT requirements, making sure that the mezzanine or the first loss piece that had been sold really transferred as much risk as possible. So, as I said, the Frankenstein monster, you've got parts of this monster that come from, or this creature, that come from an investor protection measure. So the mezzanine investor has to be protected. And there are rules about collateral, for example, that are there to protect the investor. And then you've got another part, which is an SRT point. Of course, the logic of SRT, significant risk transfer for the regulator, is that as much risk is transferred as possible to the investor. So you've got part of the rule saying we want to protect the investor against risk, and you've got another part of the rule saying, but he needs to take as much risk as possible. And so it is a bit of an odd creature. And it makes interpreting the rules quite difficult because the people who drafted the rules were schizophrenic as about what they tried the rules to do. But yes, basically, the genesis of the synthetic STS is you start with the true sale securitization criteria, the 103 that I mentioned, and then you add, so there are three categories: simplicity, standardization, and transparency. So all the criteria fall in those three buckets. Those buckets have been taken up in synthetic, and you still have a simplicity, standardization, and transparency bucket. They've added special rules. Some of them make sense because synthetics do have things that true sale doesn't, like a verification agent. So you did actually have to deal with that. And then they, on top of those, so the 103 became like 120, 125, and then they put on top of those a whole set of synthetic-only criteria, and that's where a lot of this SRT stuff lives in the synthetic editions, which means that to have a synthetic STS securitization, you now need 145 to 160 separate criteria being met. It is not simple.
Well, as you mentioned, there are some criteria that are high and low lights, as you said before. I'm not sure you want to talk about this slide, or shall we?
No, I mean, I think this is just to give a flavor at this stage. I mean, we could do another seminar focusing much more specifically on what the STS regime requires for synthetic. But basically, you know, what you see here are some of the things. Homogeneity is required. You have to have homogeneous pools. And then you have some SRT stuff. So it's only on balance sheet exposures. The only things that can be STS in the synthetic world are transactions which are designed to remove capital from on-balance sheet exposures. You can't do an STS deal because you've perceived an arbitrage, you think you can do an arbitrage in the market. That is not allowed to be STS. You have to basically do the STS transaction. First of all, it has to be EU bank. So hedge funds that could see a way of making money from an STS capital-weighted synthetic are not in this game. They're not allowed to be. It has to be EU bank, prudentially regulated EU bank, basically removing risk from its balance sheet. That's the only type of securitizations that's allowed to play. On the other hand, there are also a number of, as I said, investor protection measures which come from the true sale. So you can't have credit-impaired borrowers to avoid subprime. Now, in a way, that's not consistent with the other rules on SRT. If I was looking at it from an SRT point of view, I'd love my banks to remove subprime risk from the balance sheet. But that's not allowed in STS because that comes from the other bit of the Frankenstein monster. There are minimum mandatory credit events. You have to have a verification agent. You have to do a pool audit, which, by the way, if you're going to do synthetics, is never done in synthetic land, at least not in the way that a pool audit is understood in STS. So there are certain things that have changed. Basically, the rules, as I said, are long and complicated. By and large, they mold themselves relatively well to synthetics deals being done in the market. You don't have to take your previous synthetic deal if you've done a synthetic deal and completely shred it and start from scratch. Mostly the rules fit the existing market, but it's mostly, not entirely. Well, and with 145 to 160 rules, do not expect, if you have done any synthetics, to come to the STS market and be able to change nothing at all. That's not going to happen. There are things that are going to have to change.
I think, one of the, drawbacks or the fact that this was the fastest ever approval process we've seen is that a lot of things had to stay the way they are, right? So there's always a price to pay, right? Yes. So if I move to the next slide, I'm not sure you want to mention anything here on this one.
No, again, these are sort of a taster of the kind of complexities you have. So there are very complicated rules about collateral and how you can. There's even a full slide on that. One outstanding issue is synthetic excess spread. So in a true sale securitization, all the money goes to the investors, and then if there's any extra that they don't need because they've been paid in full the interest, then it goes back to the originator, which is, if you will recall, I said you can do securitization and still have a stream of income coming back from the servicing, giving you this infinite return on assets. That stream of income, which is what the investors don't need to pay interest, but which is generated by the underlying asset as a result of that wholesale retail arbitrage, is called excess spread. And excess spread, usually in a true sale securitization, is used to cover the investors, usually. In synthetic securitization, you can have what's known as synthetic excess spread, which is an amount where you say, this is the extra cash that I generate out of these assets, and I will give them to you, investor, to limit or to reduce the amount you have to pay under your insurance under the synthetic securitization. So synthetic excess spread is actually quite complicated. And it became a very politically sensitive point, strangely enough. Apparently, the Finns and the Dutch didn't like synthetic excess spread being used in synthetic securitizations. The EBA thought it was fine, and so a compromise was made, which is that there will be a regulatory technical standard issued soon that basically the compromise was you can use synthetic excess spread, but you're going to need to put some capital against it as a bank. You're going to need to capitalize that synthetic excess spread. How much capital you need to put against it, how the capital is going to be calculated, has been left to an EBA regulatory technical standard that we're expecting before the end of the year. That's going to be very important for the market, because depending on what the EBA says and the Commission agrees, deals that require excess spread will either be doable economically or they will not be doable economically. So some synthetic deals don't have excess spread, that's fine, they don't care. But if you have deals, certain types of assets with high levels of losses and high levels of interest rate, those types of assets where you traditionally use synthetic excess spread in your synthetic deal, whether those get to be done or not in the future will depend crucially on where the EBA comes out with this regulatory technical standard before the end of the year. And so the market is sort of holding its breath a little bit to see what the impact of that regulatory technical standard will be.
Yeah, and another, I would say, interesting, as you call it, schizophrenic rule is the one we're looking at, which is, I think, a result of a compromise between the northern states and the southern states when it comes to guarantees, which end up, and the different rules that exist in CRR, which you end up with a four-lone diagram, and I think you can explain a bit more about that, but I think it's another example.
So we said that certain types of synthetics are funded. Obviously, all the ones that proceed by credit-linked notes are funded by definition because it's a note. But even others proceeding by credit default swaps or proceeding by guarantees can be funded. Why is that? We talked about SRT. We said if you insure your risk through a synthetic, then you should be able to get a reduction in capital. Complicated, but you should be able to get it. But here's the point: if it's just pure insurance, you as a bank have removed the risk of the assets in the mezzanine piece between 10 and 100 million by getting this insurance, but you've just swapped the risk because you now have to rely on the insurance company or the investor, the synthetic investor, being there. You've got a synthetic investor that says, yeah, sure, I'm happy to write a contract, a guarantee, a synthetic securitization for 90 million euros, but I may not have 90 million euros. I'm just having a punt. I'm hoping that it never comes through because I don't have any money at all. So the bank now is at risk on the synthetic investor who may or may not pay when he's asked to pay the 90 million or part of the 90 million. The prudential regulators quite sensibly have said, therefore, you can't remove capital for that 90 million euros. All you can do is you can switch the capital from what the K, remember KA, KB, KC, that's KB. You can switch the capital of KB and replace it with the credit risk of your synthetic investor. Now that works perfectly well if your synthetic investor is a European investment fund or the European Investment Bank. It's AAA rated, it's a multilateral, and therefore the capital requirement for that is 0. That's great. So that's still a win because you've removed the capital. But if it's anybody else, then you're simply switching capital for capital risk. Unless you say to your synthetic investor, I want you to give me the cash. I want you to give me the 90 million up front. Now, obviously, I'm going to return those 90 million to you if there's no losses on the pool. But I want you, the investor, the synthetic investor, to collateralize your obligation to pay me for my defaults upfront in cash. And that is collateral. And it makes sense because cash is cash, and therefore the regulator will accept that means the risk is gone. What you do with that collateral and where you can put it is the subject of a complicated series of rules in the STS synthetic regime. Those rules are summarized here, and the real question mark is normally the cash is kept by the bank that is the originator. So the investor takes the risk of the bank. And whether that is acceptable or not in STS depends on the rating of the bank. And it was supposed to be CQS2 if it's the originator bank. And then people pointed out that in countries with low sovereign ratings, I mean, Greece is one of them, but Italy also, Portugal, Malta, you can't get to CQS2 as a bank. And therefore, all of a sudden, the deal was going to completely remove the possibility of the cash being held by the originator bank, and that dramatically changes the economics of the deal for the bank. And so there was a compromise, as there usually is, which is we kept CQS2 to make the northern countries happy, but we provided an out by saying that if your local regulator agrees, then it can be CQS3. Why any local regulator would not agree, why any local regulator would make it more difficult for the banks under his regulation to get better capital position by removing risk is a little bit of mystery, but that's the compromise. It worked politically, so we took it.
Okay, and I think, though, that we're not still completely done with synthetic, right? There are several things that are still pending. We're waiting several regulatory standards that are still pending. You want to go quickly through that?
Yeah, so there's a whole bunch of stuff that's still not decided. Homogeneity, your pool has to be homogeneous in order for it to be STS. There is existing true sale homogeneity, RTS, but there's a new one coming. We think it's going to be very similar, but we just need to see that. Highly technical issue of pro rata triggers. There's a requirement for, if you've got pro rata amortization of your synthetic STS deal, that pro rata amortization has to stop when certain things happen, but what those things are is yet to be defined by the EBA. Sustainable disclosure is a red herring. The European Parliament said that if you do an STS synthetic, you have to disclose if you're doing autos or RMBS, green information. It's a fetish of the Parliament. They put it in every legislation, but it's not really, I think, going to change much. Synthetic excess spread, of course, is something we've discussed, and that is very, very important. So particularly for, as I said, assets with high yields and high defaults. And green securitization, EBA has until November the 1st to publish a report on how to structure a green securitization framework. Nothing to do with STS per se, but again, there's a lot of movement in Europe on green. The EBA has started consulting privately on this issue. We've spoken to them about it. We're basically telling the EBA, please, please, please do not create a specific securitization green framework, which is as is usually the case when the EBA gets its teeth into securitization, 5 times more complicated than everybody else's. So those things are still pending. We shall see where they come out. But the two, I mean, the two that are really important are the pro rata triggers and certainly the SES. The green securitization is actually very important, but not for synthetics. It's just very important for securitization as a whole. But it's sort of not really attached to the synthetic issue.
Thanks, Ian. I mean, one thing that I guess the Commission has learned from the STS, when I was at the Commission and they were drafting the grandfathering rules for those existing transactions, I told them if they keep the rules as they are, hardly any single transaction will be grandfathered. I mean, I told them maybe you get one transaction grandfathered, maybe none. And unfortunately, I was right. And a lot of people probably told them the same thing. And I think they learned from that. And now the grandfathering rules are much broader and much easier if somebody has done a synthetic transaction to grandfather to become a synthetic STS. And I think there's nothing more to say. I mean, if people have more questions, they should call us because that's a complicated technical matter. But it is possible to grandfather synthetic STS. Yeah, unless you have something else, we have a very interesting question for the SRT. I'm not sure you want to take that one.
Yes, we are promised by the EBA that the draft SRT RTS should be there before the end of the year. Then, of course, it has to be put to the Commission, and actually technically put to the Council and the Parliament, but they won't. It's a negative procedure. Basically, they've got 30 days or 3 months, depending, to object, which they won't on this topic. It's too technical. So basically, we should expect something by the end of the year, we are told by the EBA.
Okay. I think we already discussed that, but that's very technical. There are 2 verification names, and that's a confusing thing. But
I mean, as I said, the slides are really there to take away and read at leisure. There's no way we would have gone through all the slides. So, if we can move to the Q&A, I think is probably the best at this stage.
Okay, so I think we can open now the floor for questions. So please post them on the chat if you have any questions, and if not, then we will give the mic back to Mr. Haralabidis for closing remarks. So we'll wait 1 or 2 minutes, and if not, then we'll wrap up. Hi, Mike.
Yep.
You have any question, Alex? Mike, I think if you have any questions, unless you.
At this point, so if somebody thinks of anything and they want to ask us, they browse the material we send out, please feel free to reach out. But at this point, I see no other questions. We answered quite a few during the session, so we can wrap it up.
Maybe, Mike, you have a question that you want to raise that we forgot to mention, given that we had to cover a lot of ground in a limited amount of time? Or if not, then the floor is yours.
Yes, I think first of all I want to on behalf of HFSF to thank you very much, Ian Bell and Harry Noutsos, for this very interesting and insightful presentation. I think we can let's say renew our meeting for after the summer vacations. I think there are some very interesting topics about green securitization, which is very, very interesting and very, very hot. And I think it's nothing yet happens in Greece regarding this area. But I think the people will, a lot of people would like to see what's happening in Europe and in the rest of the world. And of course, we have also to think about the topic of NPL securitization, which is very, very important for Greece due to the market which is expanding rapidly here in Greece. Again, I think we had a lot of questions that you answered during the session. So here, I think, again, I have to thank you and to wish you, to have a nice summer vacations, to relax, and to meet again on September, October with a new topic. Thank you very much.
Definitely. Thank you very much.
Thank you.
Bye-bye.
Bye.
Bye.